Panic is no longer just a rumor people talk about online or an idea on message boards. It has officially reached the top levels of the United States government. For years, we have warned you that the day would come when the powerful people, the people who print money and control the military, would wake up and realize that they cannot print silver. We told you that when the real shortage finally happened, the government would not just stand by and watch the markets fall apart. They would step in. They would move to take control of the supply. They would move to get the physical materials needed for the country to survive. Well, ladies and gentlemen, that day is here, and even Asian guy is here, known as John A.G. from Currency Archive. While regular people were busy with holiday shopping, and while the mainstream financial news was talking about Bitcoin and tech stocks, the United States Department of Defense quietly completed one of the most important strategic moves in the history of the metals market. We are now getting confirmation of a massive game-changing deal that was signed behind closed doors around December 15th, 2025. The ink is dry. The money is set aside. The message is crystal clear. The United States is terrified of running out of silver. Here's the reality that the paper traders are ignoring. The United States government, through the Department of Defense and the Department of Commerce, has partnered with Korea Zinc to build a massive $7.4 billion critical minerals processing facility in Clarksville, Tennessee. This is not a small grant. This is not a research paper. This is the first major non-iron metal smelter to be built on American soil since the 1970s. Think about that. For 50 years, the United States was happy to let China and other nations process its metals. We sent out our dirty work and brought in the finished product. But now, in the middle of a silver squeeze, suddenly Uncle Sam is dropping $7 billion to bring the processing home. Why now? Because they know what we know. They know the global supply chain is breaking. But the dollar amount isn't even the most shocking part of this deal. You have to look at the structure of the ownership to understand how much panic there is in Washington. This isn't just a private company getting a loan. The Pentagon, the United States military, is taking a 40% ownership stake in this project. Now, let me repeat that so it sinks in. The Department of Defense will own nearly half of the production capacity of this facility. They are not just a customer, they are the owner. This means that the silver, the zinc, and the indium that come out of this smelter are not going to the open market to lower the price on the markets. They are not going to be sold to JP Morgan to help them cover their bets. They are going straight into the strategic stockpiles of the U.S. military. They are being removed from the regular market before they are even refined. This project, which is being financed in part by JP Morgan, and we will get to their role in a minute, is designed to process 1.1 million tons of raw material every year. It will produce 13 specific non-iron metals. And guess what? 11 of those 13 metals are listed as critical minerals by the U.S. Geological Survey. Silver is at the top of that list. The government is effectively taking control of a portion of the supply chain because they realize that without silver, they cannot build the Tomahawk missiles, the F-35 fighter jets, or the next generation satellites that they need to compete with China. They looked at their stockpiles in December. They looked at the export ban coming from China in January, and they panicked. They realized they were exposed, and this effectively proves every single thing the silver squeeze community has been saying for 5 years. We said silver was a strategic metal. They called it a pet rock. We said the industrial demand would be more than the supply. They said we were crazy. We said the government would eventually have to step in to get metal. They said the free market would handle it. Well, does a $7.4 billion government-backed smelter look like the free market to you? No, it looks like a desperate attempt to get resources during a crisis. It looks like resource nationalism. And it proves that at the highest levels of power, they view silver not as a currency to be controlled, but as a material that must be secured at any cost. So when you look at the price action today on January 5th, 2026, do not look at it alone. Connect the dots. On December 15th, the Pentagon signs the deal to secure metal. On January 1st, China bans exports. On January 5th, the price in Shanghai explodes to $82. Do you think these events are happening by accident? Of course not. The smart money, and in this case, the government money, moved first. They secured their supply in December because they knew the price was going to explode in January. They bought their insurance policy before the house caught fire. And now you're watching the flames. And this brings us to the most ironic twist in this entire story. The organization that is helping with this massive shift from paper to physical is none other than our old enemy, the very designer of the paper suppression scheme itself. We need to talk about the bank that is organizing the financing for this smelter. We need to talk about JP Morgan because if you think they are financing this deal just to make a few dollars on interest, you are missing the bigger picture. They are not doubling down on their short position. They are protecting themselves against their own collapse. They are preparing for the death of the paper market that they created. Let ES look at why the biggest short in history is suddenly financing the biggest physical infrastructure project in 50 years. You have to understand that JP Morgan is not a gambler. They are the house, and the house never bets on a losing horse, if they can help it. For the last 15 years, we have rightfully called them the enemy. We have documented their cheating, their massive short positions, and their manipulation of the futures market. But do not make the mistake of thinking they are stupid. They are the most sophisticated commodity trading organization on the planet. And if the biggest shorter of silver is suddenly pouring billions of dollars into financing a physical smelter in Tennessee, it is because they know the game has changed. They are admitting with their wallet that the era of paper is over. They see the same data we do. They see the deficits. They see the Chinese solar demand. They see the breakdown of the London fix. And they have realized that in a world of physical shortages, holding a paper short contract is a suicide mission. If the price goes to $200 an ounce, their paper shorts will bankrupt them. But if they finance the smelter, if they control the facility that produces the metal, then they are no longer the short seller. They become the gatekeeper. They are switching from betting against the price of silver to owning the flow of silver. This deal with Korea Zinc is their escape pod. While they are issuing research notes telling you to exit the market, while they are telling regular people that silver is overvalued at $75, they are quietly writing checks to build the infrastructure that will control the supply for the next 30 years. They're effectively bringing their own business model home. Instead of relying on the London vaults, which are empty, or the Chinese refineries, which are now closed to the west, they are building a fortress in Tennessee where they can process the metal themselves. And you have to look at where this metal is coming from. This smelter is specifically designed to process raw materials from Latin America. It is built to take the raw ore from Mexico, from Peru, and yes, potentially from a post-conflict Venezuela, and turn it into strategic bars for the US military. JP Morgan knows that Latin America produces the silver, but historically, that silver was shipped to China for smelting. By financing this plant, JP Morgan is helping the US government cut China out of the loop. They are creating a closed loop supply chain. Latin American mines to Tennessee, smelter to Pentagon missiles, and JP Morgan sits in the middle financing the trade, likely taking a cut of every ounce and making sure that they have first access to the physical bars when the squeeze goes vertical. This is the ultimate insider move. They are telling the world sell, but they are buying the factory. They are moving from paper games to physical infrastructure because they know the squeeze is real. They know that when the Shanghai price disconnects from the market price, which we are seeing right now with that massive difference, the paper market becomes useless. The only thing that matters is who has the physical metal. And by the time this smelter comes online, JP Morgan intends to be the king of physical. So do not be angry at them, learn from them, copy their trade. They are getting as close to the physical metal as possible. They are bypassing the futures contracts and going straight to the source. You should do the same. Every ounce you buy today is an ounce that JP Morgan wishes they could control. You are effectively front-running the bank that is front-running the world. And this move by the banks and the Pentagon creates a harsh reality for the global market. While Washington and Wall Street are frantically building lifeboats in Tennessee, the water level in the rest of the world is rising fast. The disconnect they are preparing for isn't in the future. It is happening right now on the other side of the Pacific. While the Americans build plans for 2029, the Chinese have already made their move in 2026. We need to look at the scoreboard today. We need to look at the price that is screaming at us from Shanghai. Because while JP Morgan prepares for the long war, the battle for the immediate price is being fought in the Chinese market. And the numbers coming out of China this morning are absolutely devastating for the paper shorts. Let's look at the Shanghai breakout. Let's look at the $82 reality that is making the US government panic. While the market in New York is trying to convince you that silver is worth $75 an ounce, while they use their paper algorithms to paint a picture of calm and stability, the Shanghai Futures Exchange is screaming the truth. We are looking at the live data from the Asian close. The price of silver in Shanghai has just hit 18,420 yuan per kilogram. Now, unless you trade on the Chinese exchange, that number might just sound like a lot of yuan. So let's do the math together. Let's translate that into the language of the US dollar so you can see exactly how broken the market has become. If you take 18,420 yuan and you divide it by the current exchange rate, which is roughly 7.1 yuan to the dollar, and then you convert kilograms to troy ounces, you don't get $75. You get a price that is between $81 and $82 per ounce. Do you understand the seriousness of what I'm saying? Right now, at this exact second, there are two prices for the exact same thing on the same planet. In New York, silver is $75. In Shanghai, silver is $82. That is a difference. A spread of nearly $7 an ounce. In the world of high-speed finance, where traders fight each other for a difference of 1 penny, a difference of $7 is not just an oddity, it is a broken market. It is a failure of the global pricing system. It is a screaming siren telling you that the West has lost control of the price. For 50 years, New York and London told the price to the world. If New York said silver was cheap, it was cheap everywhere. But today, Shanghai has looked at New York and said, we don't care what your paper price says. We need the metal, and we are willing to pay $7 more than you to get it. This difference is the arbitrage vacuum, and it is the single most dangerous force acting on the market right now. Think about the physics of it. If you are a global metal trader, if you are Glencore or Trafigura or just a massive refinery with inventory in London, what do you do when you see this price gap? Do you sell your silver in New York for $75? Of course not. That would be financial malpractice. You put that silver on a plane, you put it on a boat, and you ship it to Shanghai immediately. You sell it for $82 and you pocket the risk-free $7 profit. This creates a giant sucking sound. It is the sound of physical inventory being pulled out of the Western vaults, out of the market-registered stockpiles, out of the London Bullion Market Association warehouses, and flowing east. It is a one-way river of wealth. The West is selling its strategic assets at a discount, and the East is buying them at a premium because they know the true value. This explains the panic in Washington. This explains the $7.4 billion smelter. The Pentagon isn't stupid. They have economists, they have analysts watching these same screens. They realize that if this difference continues, there will be no silver left in the United States by the time they need it for their missiles in 2027. It will all be in China. Every single ounce of available silver is moving towards the highest bidder. And right now, the highest bidder is the Chinese industrial complex. The United States government realized they cannot compete in a bidding war on the open market without admitting that the dollar has lost its purchasing power. So instead of bidding up the price on the market, which would destroy the illusion of a strong dollar, they decided to build a fortress. They decided to build the Clarksville smelter to trap the metal before it can leave the hemisphere. But let's go deeper into why Shanghai is paying $82. Why is the price so much higher there? Is it speculation? Is it a bubble? No, it is desperation. As we discussed on January 1st, the new export controls went into effect. But it goes beyond that. The Chinese economy is going through a massive internal change. They are actively removing the dollar from their supply chain by paying a higher price in yuan. They are encouraging local miners to keep their metal at home. They're telling the miners in Inner Mongolia and Yunnan, don't export. We will pay you better than the Americans. And at the same time, they are draining the international market. This $82 price is the real price. The $75 price on the market is the paper price. The paper price is set by banks trading futures contracts that are settled in cash. They can print as many contracts as they want. The real price is set by factories that need physical bars to operate. They cannot print bars. And when paper meets physical wins. The 7 gap is simply the extra cost you have to pay to escape the paper matrix and hold the real thing. And look at the psychology of this breakout. For years, the gold bugs and the silver stackers were told that the market was the only price that mattered. Spot price was God. If spot was down, your net worth was down. But today, we have to ask, which spot price? If you are holding physical silver in your hand, is it worth $75 or is it worth $82? I would argue it is worth the higher number. In fact, I would argue it is worth even more because that 82 price in Shanghai is likely just the bid. The ask, the price to actually get your hands on quantity, is probably higher. The difference validates the idea that paper silver is fake. If the market price was real, arbitrage would have closed the gap in seconds. The fact that the gap continues, that it is getting wider day by day, proves that the market is broken. It proves that the metal in New York is tied up. It is stuck. It is reused multiple times. It cannot move fast enough to satisfy the demand in Shanghai. The plumbing of the Western financial system is clogged with paper derivatives, while the Eastern system is running on pure physical flow. So when you see the headlines about the smelter in Tennessee, do not think of it as a separate news story. Think of it as the US government's direct response to the Shanghai breakout. They are building a dam to stop the river of silver from flowing into the ocean of the Chinese market. They are trying to create a walled garden for critical minerals in North America, but dams take time to build. This smelter won't be fully working until 2029. What happens between now, January 2026, and 2029? What happens during the 3 years where the gap exists but the dam isn't finished, the drain speeds up, the panic gets worse, the price on the market will have to rise to match Shanghai or the market will be emptied completely. This is the catch-22 for JP Morgan and the Fed. They want to keep the price low to hide inflation, but if they keep the price low, they lose all the metal to China. If they want to keep the metal, they have to let the price rise. They have lost control. The $82 reality is forcing their hand. And this brings us to the strategic importance of the location. Why Tennessee? Why a smelter that processes raw materials? Why is this specific facility the chosen solution to the Shanghai problem? Because the United States has realized that it cannot just rely on recycling or small local mines. It needs to tap into a massive source of new metal, a source that is currently moving towards China's orbit. It needs to stop the supply from Latin America. It needs to secure the flows from the chaotic, resource-rich nations to our south before they sign long-term contracts with Beijing and Yuan. This project is bigger than just a factory. It is a geopolitical anchor. It is a move to secure the supply lines of the Western Hemisphere. Let's look at this strategic reshoring. Let's look at why this project is being called bigger than Venezuela. When we say this is bigger than Venezuela, we are not exaggerating. We are talking about the fundamental rewiring of the global energy and defense supply chain. For the last 30 years, the West has been playing a dangerous game. We allowed the midstream, the smelting and refining work to move almost entirely to Asia. We were happy to dig the rocks out of the ground in Nevada or Peru, put them on a boat to China, let them refine it, and then buy back the finished metal. It was cheaper, it was efficient, and it worked. As long as the world was peaceful, but the world is no longer peaceful. The world is breaking apart. And in a broken world, if you do not control the smelter, you do not control the metal. The Pentagon looked at the map and realized a terrifying truth. North America processes less than 10% of the world's critical minerals. China processes 80 to 90%. If a war starts tomorrow, or if a trade embargo like the one we saw on January 1st gets worse, it doesn't matter how much silver ore we have in the ground in Mexico. If we can't turn that rock into high-purity military-grade bullion, we have nothing. We have dirt. And you cannot put dirt into a hypersonic missile guidance system. This $7.4 billion facility is the answer to that strategic nightmare. It is designed to be a critical minerals fortress. It will process 1.1 million tons of raw material every single year. And while the headline says zinc smelter, do not let that fool you. Zinc is just the carrier. The real prize is what else is hidden inside that ore. This facility will produce 13 specific non-iron metals. 11 of them are on the U.S. Geological Survey's critical minerals list. We are talking about indium, which is important for touchscreens and solar panels. We are talking about gallium and germanium, the building blocks of semiconductors and night vision goggles. And of course, we are talking about silver. The strategy here is what military planners call interdiction. Right now, most of the silver and zinc raw materials produced in Latin America in the rich mines of Peru, Chile, Mexico, and Bolivia are loaded onto big ships and sent across the Pacific Ocean to Chinese smelters. China buys the raw earth, refines it, keeps the strategic byproducts for itself, and sells the leftovers back to us. The Tennessee smelter is designed to stop that flow by building a world-class facility in the American South, closer to the source. The U.S. is trying to create a pull that is stronger than China's. They want the miners in Lima and La Paz to send their ships north to New Orleans and up the Mississippi River to Tennessee instead of west to Shanghai. They are trying to cut the supply line that feeds the Chinese industrial beast. This is where the Venezuela connection becomes important. We know that Venezuela sits on massive undeveloped mineral wealth. Not just oil, but gold, iron, and potentially vast silver reserves that are basically off the grid. If the rumors of a yuan for oil deal are true and the blockade suggests they are, then China is actively trying to lock down Venezuela's resources. The U.S. cannot allow a Chinese resource colony to exist in its own backyard. This smelter gives the U.S. a business weapon to fight back. It allows them to say to Latin American nations, "We will process your metal here. We will finance your mines. We will bring you into the fortress North America supply chain." It is an attempt to rebuild the Monroe Doctrine, not with warships, but with blast furnaces. And look at the timing of the construction. Site preparation begins in 2026, construction in 2027, operations in 2029. This timeline tells us exactly when the Pentagon expects the resource war to peak. They are racing against the clock. They know that for the next 3 years, we are vulnerable, we are exposed. But they are betting $7 billion that by the end of the decade, the world will be divided into two separate economic blocks, the East and the West. And in that world, the only metal you own is the metal you can touch. This is why JP Morgan is involved. They are not just the financer. They are the logistics coordinator. They are the ones who will write the contracts with the mines in Peru. They are the ones who will protect against price risk. They are positioning themselves to be the toll booth operator for the entire Western Hemisphere S metal supply. They are effectively privatizing the strategic stockpile. And do you think they are doing this because they expect the price of silver to go down? Do you invest $7 billion in a factory to produce a product that is becoming worthless? No. You make that investment because you believe the product is becoming priceless. You do it because you believe that access to physical metal will be the key competitive advantage of the 21st century. This smelter is the final nail in the coffin of the globalist trade model. It is the end of just-in-time efficiency and the beginning of just-in-case security. It is the admission that the free market failed to protect national security, and now the heavy hand of the state is taking over. And for the silver investor, this is the most bullish signal imaginable. When the most powerful military on Earth and the most powerful bank on Earth join forces to collect your asset, you don't sell, you buy. You realize that you're holding a piece of national security. You're holding the very material that the superpowers are fighting to control. But there's one final piece of this puzzle that we must address. We have talked about the geopolitical war. We have talked about the industrial war. But we haven't talked about what this does to the pricing system itself. Because if the Pentagon is buying physical and China is buying physical and the smelters are being built to hoard physical, what happens to the paper contracts on the market? What happens to the billions of ounces of paper silver that trade every day in New York pretending to be real? If the real metal is being locked away in military vaults and Chinese reserves, the paper market loses its underlying asset. It becomes a ghost, and ghosts eventually disappear. We need to talk about the death of paper. We need to talk about why this deal proves once and for all that the futures market is walking dead. Let's look at the disconnect. Let's look at why physical is king. We've talked about the solar chokehold. We have talked about the Shanghai breakout. And we have talked about the Fortress America strategy in Tennessee. But what does all of this actually mean for the price of silver? It means that the pricing system we have used for the last 50 years, the futures market, is dead. It is walking dead. The $7.4 billion investment in the Clarksville smelter is the death certificate of paper silver. Think about the logic here. If the market futures market actually worked, if a paper contract was truly as good as physical metal, why would the Department of Defense need to spend $7 billion to build a factory? If they could just buy paper silver on a screen and take delivery whenever they wanted, they wouldn't need to partner with Korea Zinc. They wouldn't need to take 40% of the production. They would just buy the dip. The fact that they are pouring concrete and steel into the ground proves that they know the paper market is fake. They know that when the crisis hits, when the missiles need to fly or the grid needs to be rebuilt, you cannot melt down a futures contract. You cannot put a digital promise into a guidance system. You need the physical atom element 47. And they know that the paper market is effectively printing more claims than there are atoms in existence. We have discussed the ratios before. For every ounce of physical silver in the market vaults, there are hundreds of ounces of paper silver traded. This fractional reserve system works fine when everyone is calm. It works fine when nobody wants delivery. But what happens when the Pentagon wants delivery? What happens when China wants delivery? What happens when JP Morgan, the very creator of the paper game, decides to stop playing and starts hoarding the physical bars coming out of Tennessee? The game ends, the musical chairs stop, and there are no chairs left. This deal in Tennessee is the signal that the big players are cashing out of the casino. They are taking their winnings from the paper manipulation scheme and converting them into hard assets before the casino burns down. They are leaving the regular investor holding the bag of worthless paper contracts while they lock the doors to the physical vault. This is why the difference between Shanghai and New York is getting bigger. Shanghai is trading the real price because they are trading physical. New York is trading the fake price because they are trading paper ghosts. And as this smelter comes online and as the supply from Latin America gets sent directly to Tennessee, the market will become even less important. It will become a museum of price discovery while the real market happens behind closed doors and exclusive supply agreements. So when you ask, is paper silver fake? The answer is no longer a theory. The $7 billion receipt from the Pentagon is the proof. They are betting on a world where physical possession is the only law. Physical is king. And if you're holding paper, if you're holding an unallocated pool account or an ETF that doesn't allow you to take delivery, you're effectively holding a donation receipt to the banks. You're funding their transition to physical while you get left with nothing. This is the great decoupling. The price of paper silver might go to zero, or it might go to infinity, but it won't matter because you won't be able to exchange it for metal. The metal will be in Tennessee. It will be in Shanghai. It will be in the safe of the person who understood that possession is 9/10 of the law. And in the silver market, it is 10/10 of the law. So we have the geopolitical panic. We have the bank pivot. We have the death of paper. What is left? What is the final instruction for the individual investor who is watching this battle of giants from the sidelines? You can't build a smelter. You can't buy a mine in Peru. But you can do one thing that puts you on the same side of the trade as the Pentagon. You can follow their lead. Let's wrap this up with the conclusion. Let EES talk about how to position yourself in a world where the government is hoarding the very asset you own. Let's look at the Scottsdale Mint connection and the final verdict. So the strategy is simple. You do not listen to the Federal Reserve Chairman when he stands at the podium and tells you that inflation is under control. You do not listen to the Treasury Secretary when she tells you that the supply chain is strong. You do not listen to the bank analysts who tell you that silver is an old relic that gives you nothing. You ignore their words completely. Instead, you watch their actions. And right now, the actions of the United States government are writing a $7.4 billion check to secure the very metal they tell you not to worry about. This is the ultimate tell in the game of poker we are playing. If silver was truly abundant, if the price was truly meant to stay at $75, the Pentagon would simply buy it on the open market as they needed it. They would not be taking 40% of a massive industrial project. They are acting like a prepper. Who knows a storm is coming? They are filling the pantry. They are boarding up the windows. And if the most powerful military on the planet is prepping for a shortage, you would be a complete fool to be selling your inventory. You should be doing exactly what they are doing. You should be accumulating. You should be securing your own personal supply chain. And this brings us to an important connection for the regular investor, a detail that connects the massive geopolitical chess moves in Tennessee directly to the coin in your pocket. We need to talk about Korea Zinc. This is the company the Pentagon chose. They didn't choose a generic mining company. They chose Korea Zinc because they are the gold standard, or rather the silver standard of refining technology. But here's what you might not know. Korea Zinc is also a primary supplier of silver blanks and bullion products to some of the most respected private mints in the world, including the Scottsdale Mint. When you buy a stacker bar or coin from a mint that gets supplies from the same supply chain as the US military, you are not just buying a collectible. You are buying military-grade collateral. You are buying the exact same molecules that the Department of Defense is now desperate to lock down for their missile guidance systems. This proves the quality and the strategic importance of the regular product. It means that the stacker bar in your safe is not just a chunk of metal. It is a piece of the same strategic pie that JP Morgan and the Pentagon are fighting over. They are fighting for the industrial output, you are holding the investment output, but it all comes from the same scarce source. And as this smelter comes online and as the supply tightens, the extra cost on that specific high purity metal is going to explode. The mints that have established relationships with these strategic refiners like Scottsdale will be the only ones with product to sell. Everyone else will be waiting in line behind the Tomahawk missiles. So this is the message for January 5th, 2026. The window is closing. The government has officially entered the market as a whale. When the government becomes a buyer, price sensitivity disappears. They will print whatever amount of fake currency is necessary to get the metal. This puts a permanent, unbreakable floor under the silver market. The Shanghai breakout to $82 is just the warning shot. The 7 billion smelter is the declaration of war. We are entering a period of history where return on capital doesn't matter as much as return of capital. The paper system is burning. The debt cannot be paid. The derivatives are toxic. The only safe harbor is the physical asset that has no counterparty risk, the asset that conducts electricity, the asset that kills bacteria, the asset that reflects light, silver. Do not let the ups and downs shake you out. When they crash the paper price next week, remember the Pentagon. Remember that while the price on your screen went down, the government just spent billions to make sure they have enough. If they aren't selling, why should you? Be right. Be patient and sit tight. You are holding the winning hand. The shortage is real, the panic is real, and the squeeze is inevitable. This is John A.G. from Currency Archive. The government has shown its cards. Now it's time to play yours. Hold the line.